Hey everyone, if you're trying to figure out what on earth is happening in the global energy markets right now, you are in the exact right place. Welcome to this analysis of the 2026 energy landscape. From the start of the year right up to now, this sector has been incredibly volatile. We're talking a story of huge highs, dramatic drops, and constantly shifting geopolitical sands. We're going to break it all down step by step, digging into the raw data to see exactly how and why the world's most critical commodities are behaving so erratically.
All right, here is our roadmap for today. First, we'll look at the big picture, the 2026 energy landscape. Second, crude oil's boom and cool down. Third, natural gas, summer and AI. Fourth, gasoline's volatility and risk. And finally, we'll wrap up with the uncalm energy sea. Let's get into it.
Section 1, the 2026 energy landscape. To really wrap our heads around the sheer scale of the volatility we've seen this year, we have to look straight at the raw terminal data. It is literally a sea of stark reds and deep greens. It's pure market emotion happening in real time, with major assets swinging wildly in totally opposite directions just based on the news of the day. It perfectly captures the chaotic energy of the commodities market this year. So, how do we make sense of that chaos? Well, we really have to view 2026 as a tale of two completely different quarters. Q1 was all about economic optimism, high hopes for global growth, strong recovery in consumer demand, but then Q2 hit, and all that optimism was totally overshadowed by geopolitical panic. We saw severe tensions in the Middle East, real genuine fears of supply chain disruptions, and to just add fuel to the fire, there were these continuous, unpredictable shifts in global interest rate expectations. Honestly, it was the perfect storm for a roller coaster market.
Moving on to Section 2, crude oil's boom and cool down. Now, crude oil is absolutely the main character in our 2026 story. It is a textbook example of extreme peaks followed by sudden dramatic drops. The two major global benchmarks, WTI, or West Texas Intermediate, and Brent crude, moved in this aggressive tandem. Back at the start of the year, Brent was trading pretty calmly around $60 a barrel, and WTI was near 56. But tracing their trajectory upward, both assets saw incredible, nearly identical gains of around 100 to 112%.
And that massive upward climb, it peaked in May and early June, pushing prices to a staggering $120 per barrel. $120! And why? Pure geopolitical fear. Tensions in the Middle East reached an absolute boiling point, and the market was just terrified of a major shipping disruption through the Strait of Hormuz. Because when the market fears that oil literally cannot physically get out of the Middle East, a massive risk premium gets baked right into the price. And that is exactly how you hit $120.
But then, the narrative flipped. Instantly, news broke of a preliminary peace deal between the US and Iran. Almost overnight, that massive risk premium just evaporated. We saw a precipitous 32% drop from those peaks. Brent plummeted down to around $81 a barrel, and WTI fell to about $78, marking its lowest point in roughly 3 months. As the panic subsided, the gap between those two benchmarks narrowed significantly.
So the crucial point to understand right now is that the crude oil market is being aggressively pulled in 4 different directions. On one hand, we've got easing geopolitical tensions and expectations that the Strait of Hormuz will normalize, which obviously pushes prices down. But we also have surprisingly sluggish consumer demand out of China keeping a lid on things. And hovering above the whole situation is OPEC+, the coalition of the major oil exporting nations, still maintaining immense control over global supply limits. It's a highly reactive environment. Literally, the slightest geopolitical whisper could reverse these trends in a matter of hours.
All right, Section 3, natural gas, summer, and AI.
While oil has been totally dominated by old-school geopolitical conflict, natural gas is being driven by a surprisingly modern catalyst. The Henry Hub natural gas futures are showing this steep, jagged climb. Compared to its pretty dismal performance over the last couple of years, we're seeing a definitive recovery here, with contracts actively trading up around $3.2 per unit. That's a clear, solid jump from where we started the year.
Now, the push and pull happening behind the scenes here is fascinating. On the bullish side, pushing those prices up, we have intense summer heat driving electricity demand, plus strong, consistent liquefied natural gas, or LNG, exports. But you want to know the real wild card? Artificial intelligence. The absolute explosion of AI data centers is requiring a staggering, colossal amount of electricity, and that is just supercharging natural gas demand. However, on the bearish side, keeping prices somewhat in check, the US is pumping out record-breaking production volumes, and inventory levels are already super abundant. So it's this crazy tug-of-war between next-generation tech demands and record domestic supply.
Section 4, gasoline's volatility and risk.
If you thought oil was a roller coaster, the wholesale gasoline market has arguably been the most emotional ride of the entire year. Early in 2026, when those Middle East tensions first disrupted energy flows, benchmark wholesale gasoline futures, known as RVOB, absolutely skyrocketed. These futures nearly doubled from their starting point, making gasoline one of the strongest gainers in the entire commodities market. But, just like crude, as peace talks progressed and the Strait of Hormuz fears cooled off, the market finally exhaled. By June, prices had sharply corrected down to around $2.85 per gallon.
But listen, here's the absolute most critical takeaway, the hidden danger you need to know about. Do not let those cooling prices fool you for a second. The fundamental reality of the gasoline market is incredibly fragile right now. We are entering the US peak summer driving season, meaning demand is incredibly robust, regardless of the price at the pump. Yet seasonal gasoline inventories are at a 10-year low. A 10-year low. This creates a massive vulnerability. The market is basically walking a tightrope. Any new unexpected shock to the supply chain could send prices instantly skyrocketing all over again. And finally, Section 5, the uncalm energy sea. Let's look at the big picture.
So we've covered the wild swings in oil, the tech-driven recovery of natural gas, and the super fragile state of gasoline. To tie it all together, there's this really powerful quote drawn directly from our source material. Translated, it means the biggest storm may have passed, but the global energy sea is still not completely calm. And that perfectly summarizes our deeply polarized landscape right now. Sure, we survived the massive supply panic of the spring. But with oil reacting violently to every headline, natural gas struggling against massive domestic supply ceilings, and gasoline inventory sitting at a decade-long low, the foundational risks absolutely haven't disappeared. The market's gravity is still firmly centered on the Middle East, the decisions of OPEC+, and the fragile health of the global economy.
Which leaves us with this crucial final thought. We are navigating a highly reactive, uncalm market with virtually zero margin for error. So, with looming geopolitical and supply chain risks still very much in play, how will this unpredictable energy landscape impact your business, your investments, or heck, even just your summer travel plans? You're definitely going to want to keep an eye on these data points, because as we've seen in the 2026 energy market, literally everything can change in a matter of weeks. Thank you so much for joining me for this analysis. Stay curious and keep learning.